welcome to one more session of tourism finance. So we'll continue our discussion from last time. So before that, we'll have a brief revision of what we have done last class. So in our introduction, we have talked about what is finance, what are its decision-making tools, what are its functions, how is it different from financial accounting, and what are the major decisions taken here. So today we will discuss about we'll go to a next step. So what are the different goals of business? Okay. So whenever we are doing business, as businessmen, as managers, as shareholders or owners, we have two broad goals. One is called as wealth maximization and another one is called as profit maximization. So the first and foremost goal or aim is maximizing shareholders' wealth. When you're saying maximizing shareholder wealth, it means whoever has invested in the company, their investment should increase in a positive way. How can this be done? By undertaking prospective profitable ventures so that in the long term run there is continuous flow of cash. So how is this wealth of the shareholders measured? When you talk about a joint stock company, means those companies who are having shareholders. So their wealth is maximized when the market price of its shares is increasing. When that happens is when the demand for the company shares is increasing. Why will the investors increase the demand of the shares? Because that company is doing good business. In future, it is going to undertake prospective profitable ventures. So in the long run, they are going to have continuous profits. So this is termed as shareholders' wealth, where the investor's wealth and not the profit is a primary objective. So if the price of the shares is increasing, they may sell it off and gain the profit. Okay, that is how stock markets run. Then there is one more concept called as profit maximization. Profit maximization is a temporary approach, not like shareholders wealth maximization where it is a long-term approach. Profit means the surplus after selling something. So if you want to maximize your profit, you have to sell more and more. How can you sell more and more? Yes, definitely if your product is good and it is known, people are trying it, then they will definitely sell it more. But sometimes what happens is even a qualitative product also sales will be less. The reason may be no proper advertisement, no proper transportation, maybe some deficiency in the sales force and so on. But if the managers are thinking of profit maximization, now why do you think so that managers will think about profit maximization? I will tell you before that. And generally for investors or owners, wealth maximization is the key aim. For managers or employees, profit maximization is the key aim. Why? Why? Because employees' salary is attached with the number of sales they have done. So more and more they will sell by hook or by crook, their income or salary will increase. So if you attach your employee salaries in such a way that if you sell more, you will get more salary, then they will think of unethical and cheap ways of selling the products. So in such unethical way, the company's name may be damaged. Okay, so many of the companies do that. They boost their or they are behind their employees to sell and more. So we can talk about insurance companies, then credit card companies, or the many more services and products. They are behind selling more and more. They are given targets monthly So if you reach that target, your salary will be so much. If you don't reach that target, you will have only the basic salary, or you will be traumatized by your boss. So for employees, profit maximization is goal. So for this, they may go for unfair practices also. So we'll compare these two goals of doing business. So as I told you, profit maximization is short-term oriented. Why? Because I'm going to think about this month's sale, next month's sale. I'm not going to talk about next year what my company will be, how I'm going to undertake new profitable ventures. Whereas wealth maximization is long-term. It doesn't think about today's profit, today's sales. Even if today's sales are a little bit less, it's okay, but they think about long-term branding, image building of the company, and prospective high profit oriented projects are undertaken. In profit maximization, the risk factor is less. Why? Because already launched product is sold continuously without thinking of doing something new. So when you're doing something new, when you're investing more, then only the risk factor comes. So in wealth maximization, as you're thinking about future sales, future prospects, so the waiting period is more. Whatever you're investing is going to stay there for a longer time without generating profits. So the risk factor here is more. Even you're doing a new project, new product launch, there is no 100% guarantee that your product will be clicked. So the risk factor is definitely more in wealth maximization goal. And profit maximization can lead in mismanagement. Uh, because you are behind sales without thinking about pros and cons, ethics, unethics, there may end up of mismanagement. There should be continuous process from the boss to the employees to do more. On the other hand, wealth maximization thinks about when to launch. It recognizes the timing of return. So if I'm investing today, from how many years or days I'm going to get my returns back. So it is a well managed, well planned venture. Okay, so this is all about the main goals of doing business. Now we'll have a brief overview of the business environment. So to start with, first we'll talk about the different types of doing businesses. So the most, you can say the first and the foremost is a very primitive way of doing business, that is sole proprietorship, where it is owned and managed by a single person. The owner and the business are legally identical. So if I'm have my own business, I'm the owner, the business is me, and I am the business. Whereas in other forms of businesses like partnership, joint stock companies, the owner and the businesses are two different things. But in sole proprietor, single ownership, owner as well as the business is one and the same. So legally, if the business is doing something wrong, legally you, the owner, are wrong. Then what are the plus and minus points of sole proprietorship? Okay, so the pros and cons of sole proprietorship. So here there is not much a mess of opening the business when you're starting the company or starting the business. There is limited paperwork. Then the second best thing here is owner is having full control of the business. He can take decisions. He can start whenever he want. He can end whenever he want. uh, the reporting system, there is no standardized way that every year I have to make the profit and loss account, I have to use this format of accounting, nothing. So there is no hard and fast rule of managing accounts. Then what are the negative points? If my business is in loss, to pay the debts or the loan of my business, my personal property, total property is at stake. So there is unlimited liability. Unlimited liability means if the business is going into loss, my personal property totally will be disposed of or sold off. Then when you are doing single owner business, you may not be having so much credit rating. So raising of funds, loans will be difficult. Then business, it may be continued by the next generation or it may be stopped. So it is not that you may, if you are there, the business is there. If you are not there, the business may be wound up also or closed also. So this is the negative part of it. Next type of business is partnership. Partnership is a business which is owned by two or more persons who are equally liable for losses. Okay, so profit and losses are typically shared by both the partners. So for this, it is not so easy like a sole proprietorship. Here you have a legal agreement where all the rights, obligation, how much to invest, all details of the partnership, how many partners are there, the name, address, their share of investment, how will be the profit shared, how will be the loss shared, in case of loan, how much he or she or the each partner has to pay the loan, all details, when it started, what are the rules, what are the rights, responsibilities, who will manage, if you are managing, how much salary you will get, if you are drawing back some money from the business, how much interest will be charged. Drawing in the sense, I invested, I want a loan from my own business, so from that, how much interest will be charged. Then on my investment, how much interest I will get. All details of that business will be written in that document. Then we'll talk about what are the pros and cons of partnership business. So the plus point is many people are there, so risk is shared, losses are shared, additional capital can be raised easily. Say for example, for a new venture, you want little bit extra money, all of them together can invest more, or all of them together which with their say connections can raise capital. Then again, the best next thing is there is no auditing, means it's not compulsory that you have to audit your accounts or you have to publish your profit and loss statements in the magazines and newspapers. It is not coming under company tax, it is coming under personal tax only. Then the negative part is, in case of loan, that if you can say if you become bankrupt or your company is making losses, then your personal property will be taken off to dispose of the debts. Then there are many administrative costs. And again, if there is a quarrel in between the partners, they may shut down. So whether the business will be continued by the next generation or the present partners, there is no surety. It all depends upon their mutual understanding. If they feel that they want to shut up the business, they will come for a meeting and then go off. Okay, somebody dies also, they may think of shutting off the business. So it all depends on their mutual concern. Here, as two or more persons are involved, decision taking may be slow. Some people may not be that smart, they are only investing and not taking part in the operations. So decision making may be a slow process. Okay, so this is all about partnership, its pros and cons. Then we'll talk about joint stock company. Okay, joint stock company means a company who is having multiple owners. So each owner is having a part of share in the business. So company joint stock business is owned by multiple owners. Shareholders' liability is limited to the nominal value. Business is legally separate from its owners. So in a joint stock company, as the number of owners is really huge, every person is only a part of the total. Say for example, the total investment of the company is a big pizza. You cut it into small bits. So that small bit is a share. So as an investor, you can buy more or less of a share depending upon your budget and how much you have to invest. So here, that's why we call that shareholders. Means they are the part owners of the business because they are invested only part of the funds. So in terms of loss or in terms of bankruptcy, only that amount which is they have invested will be lost. Their personal property will not be taken into consideration. Means if there is a bankruptcy of that company, I don't have to sell my car, house, jewelry to pay back the loan of that company. Only that amount which I have invested in buying the shares, only that nominal value will be a liability. That's why we call the shareholders are having limited liability, whereas in partnership and sole proprietorship there is unlimited liability. You may have invested 1 lakh in the business, but loss company debts are more than 1 lakh. I have to pay my personal property. Here that's not the case. Only what you have invested will go off, your personal belongings will not be taken. Here, as many shareholders are there, many owners are there, business is totally a different person or different identity, and the owners are a different person. So business is legally separate from its owners. Then what are the then joint stock company is registered. The name of the board of directors is registered. So it's a very legally, the process is very lengthy. It's not that easy. They have to make a rule book of articles of association, memorandum of association. So all the details of the company, how it was started, how much was invested, how many shares were issued, who are the board of directors, who are the founder members, what are its rights, what are the rules, ethics of the company, all should be written down in the, you can say, the constitution of the company, that is the articles of association and a memorandum of association. Then what are the benefits and negative points of joint stock company? The benefits are less risky. Less risky, why? No doubt the company as a whole is investing in huge projects, but on part of the shareholders, risk is less because every shareholders had invested small amounts. So it is like small droplets of water making a big ocean. So individually the risk is less because different people are investing small drops in that investment, and it is becoming a full ocean full of investment. Then when more and more funds are there, more and more people are investing in that company, means people are trusting that company. So if you want loan, you can raise it easily from banks, from financial companies, from portfolio management companies. Okay, then uh, because of limited liability, legal entity is different from the shareholders. This is also beneficial. Then as the company is paying corporate tax, so you can avail tax benefits from the income you received from that company. Then when you, if you are not interested in continuing the investment, you can sell off or transfer the ownership to somebody else, which is not possible in sole proprietorship. So easily you can, if you feel it is risky, you can just sell off, get the investment or sometimes more investment than what you have interested. The negative points is you have to publish, audit your accounts, publish your financial statements, profit and loss account, balance sheets in the newspapers, magazines, etc. There are certain standards of how you make your accounts, when to audit, when to publish. So there are strict reporting obligations. Then there are administrative issues. Why? Because many shareholders are there. It is managed by some other person. There are some other employees, payment of their salaries, then miscellaneous things. So there are many issues like that. Then double taxation. Double taxation, why? From the profits, you're paying corporate tax. Then personally, when you're deriving amount from here, again you have to uh, pay taxes in a limited amount. So double taxation is there. But I said tax benefit also. Tax benefit when you are, say for example, interest you are paying on loan, that is uh, uh, on that you don't have to pay taxes. Then there is legal restrictions on share issues, means the number of shares you are issuing on that. You can't just go on issuing shares and getting investment from the public. So there is a ceiling limit about how much shares you can issue at once. So this is all about the goals of business finance and the different types of businesses. So that's all for today. Any doubts, queries are always welcome. Please like, share and comment my channel and subscribe so that you get further videos instantly. Thank you. Have a good day. Bye. We'll meet in our next